All right, let's get right into it. Today, we're going to tackle a really crucial topic for anyone running a business or even just trying to understand one. What in the world are management accounts?
Hey, welcome to the Audit Guidebook channel. So glad you're here. Whether you're a student deep in your accounting studies, a new auditor just starting out, a seasoned pro, or maybe you're a business owner trying to get a better handle on things, this is for you. This explainer is a key piece of our accounting series. We're in Module 5, just so you know, and we're building up your expertise one concept at a time.
Okay, let's dive right in. First things first, we've got to build a solid foundation. So let's get on the same page and define what we're actually talking about here. So, at the very core, here's the deal. Management accounts are internal financial reports. The two magic words there are internal and regularly. Unlike those big annual reports, these are usually whipped up every single month or maybe every quarter. And their entire reason for being? To give the folks inside the company a live dashboard, a real-time look at the financial health and performance of the business.
Now, these features are what really set them apart from the kind of formal accounting most people think of. The big one, they are not statutory. That means there's no law saying you have to do them. And because they're for internal eyes only, they can be super timely and get right down into the nitty-gritty details. That also means they're incredibly flexible. A business can shape them to show exactly the information it needs to see, which is just so powerful.
So we know what they are, but the real question is, why are they so important? What's their superpower? Let's get into how businesses actually use these reports to make smart moves and, well, succeed. It's really important to see that these aren't just static documents you file away. No way. They're the engine of what we call the strategic management cycle. See, it all starts with tracking how you're doing against your budget or forecast. That lets you spot trends or problems way early before they blow up. All that info then fuels better decisions, both for the big picture strategy and for day-to-day operations. And then finally, it helps you figure out where to put your money and how to control costs, which kicks off the whole cycle again. It's a continuous loop of getting better. So what's actually in these reports? Well, you'll see some familiar faces, like profit and loss statements and balance sheets. But the real magic is in the other stuff. Things like budgets versus actuals comparisons. That's where you see exactly where you're hitting your targets and where you're falling short. And you'll also find key performance indicators, or KPIs, those specific metrics that are absolutely vital to your unique business. That's the stuff that tells the real story. We keep saying these reports are internal, right? But let's get a little more specific. Let's pull back the curtain. Who are the actual people inside a company relying on this critical information every day? It's really the decision makers at every single level. The top executives are using them for that high-level, big-picture strategy. Then you've got your department heads and line managers. They need this info to see how their specific team is doing against their budget. For private companies, the owners absolutely rely on them for oversight. And of course, the finance teams themselves are using them constantly to manage cash flow and plan for what's next.
Okay, now we're at what I think is the most important part of this whole explainer. If you get this next part, you've got the whole concept down. We're going to look at the key distinction between management accounts and those formal statutory financial statements. This is where it all clicks. All right, let's put them up side by side. On one side, we have our management accounts, and on the other, the official financial statements. Let's break down exactly how they're different. This table really says it all. I mean, look at the purpose. One is for making decisions inside the company. The other is for compliance and reporting to outsiders. The users, internal managers versus external shareholders and government regulators. And the frequency is a huge one, monthly versus just once a year. And of course, one is super detailed and flexible, while the other is summarized, standardized, and, legally required. They're just two totally different beasts. If you wanted to boil this entire topic down to one single idea, this quote just absolutely nails it. Management accounts are forward-looking and flexible. Statutory accounts, they're historical and regulated. It's as simple as that. Okay, let's bring it all home. We've covered a lot of ground, so let's distill it down to the key takeaway. What is the one thing you absolutely need to remember from all this? If you remember just one thing, please make it this. Management accounts are like the dashboard in your car. They look forward, giving you all the real-time info you need to steer the business. Financial statements? They're the rearview mirror. They look back, showing everyone on the outside where you've been. Hey, if this breakdown was helpful for you, do us a quick favor and hit that like button and subscribe to the Audit Guidebook channel.
We have so much more content just like this, especially in our accounting series, designed for students and professionals who really want to sharpen their skills.
And to leave you with a little food for thought, a question for all you business owners and managers out there. Based on everything we just talked about, what is the single most important key performance indicator, that one KPI, that your business should be tracking every single month? Give it some thought. Thanks so much for watching.